Perfect. All right. Good morning, everybody, and welcome back to We Wish You Wealth. As you can see, we have the usual suspects as always, myself, Dani Sommer, Mr. Gordon.Chavez, and Miss Ruby Ramos. Over here, we have my dear friend joining us as a special guest today, Mr. Rob Woodard from Carlsbad, California. He is a 28-year certified CFP. That sounds very professional and fancy, sir. How are you today?
I'm doing well. I'm doing well.
Good.
I'm glad to join you on Lucky Number 13 podcast.
Thank you. Thank you for joining us. Thank you for, giving us your time. We're so glad you're here. I'm sure that we have a lot of questions for you, based on the fact that we don't know a lot about certified financial planning. We are not certified financial planners. We are life insurance agents. And, as mentioned to you, our goal is to provide people with the education and some confidence as to how to approach a certified financial planner, because it can be a very nerve-wracking experience when you don't necessarily know what to ask, how to approach them. It can be a very intimidating. So we just kind of want to hang out with you, get some information, and kind of see how a CFP can kind of play a very vital role in all different aspects of your finance. So we understand that you were with Charles Schwab for 28 years. You opened a branch for them in 2020 in Temecula, right?
I'm sorry, in 2000, not 2020.
Oh,
Yeah,
okay, in
yeah.
2000. Okay.
Mhm.
And you helped with liquid investments like stocks, bonds, commercial paper, international stocks, money markets, CDs, treasuries, convertible securities, and REITs. That's a lot. On top of, I'm sure, a multitude of other things. What did you do before you got into certified financial planning, and why did you get into the business?
Oh, that's a great question. I wasn't expecting that, but I graduated in 1996 after a stint in the Marine Corps, and when I graduated, I was being primed for law school by my counselor in college. But my wife had other ideas because I had gotten a late start in life, so I was 30 years old. So it was about time to have babies, in her opinion, and mine too. And I was looking for something that could pay me immediately because all the offers I had were to work for uh, the governor's campaign uh, for a grand total of $75 a week. This was back in Georgia.
Oh,
So
wow.
at the same time, my then wife asked me, "We've got this new thing called a 401k. I don't understand it. Can you figure it out?" And I couldn't figure it out. And I called my brother, who was a stockbroker. He was literally like the Wolf of Wall Street, kind of
Okay.
selling penny stocks. And
Yeah.
so he couldn't explain it to me either because that's not what he was doing. He was selling stocks in order to get paid commissions. But it really made me interested. And what I didn't know then, I'll just leave this for a second, is that one of the greatest wealth transfers ever, we were in the middle of that back in the 80s and 90s. The
Okay.
grid came along, the companies stopped providing retirements for their employees and put the onus of the employees' retirement on themselves. So Americans before that had about a 7% of Americans owned stocks or mutual funds before that. And today, because of the advent of 403bs, 401ks, 457s, people had to become aware of their own investments. So companies like Schwab, TD Ameritrade, these companies really blew up because people needed to get advice, but they didn't want to get a sales pitch. So that's why the so-called discount brokers exploded and actually surpassed the non-discount, the full. We used to call them full commission brokers. So that's how I got started. My path at Schwab, I started out as a full commission broker, but I soon moved to Schwab, and it's all about education. It's all about trying to get better, and they were able to put me on the path to being a CFP. So I've only been a CFP for 13 years, but I did have a 28-year career at Schwab.
Awesome.
And basically, one more thing I'll say on that. People are in one of four stages of wealth. There's four stages of everybody's wealth. Creating or accumulation of assets. That's usually the first step. And then after years, so the creation is, do I get an insurance policy? Do I buy stocks? Do I put money in 401k? Do I put money in a Roth? What's the right thing to do? Do I buy a house? Do I rent? Do I lease a car? These are all accumulation of wealth decisions. And then eventually, as we start doing that, we all, and I'm kind of in this transition phase myself, we transition into kind of a retirement phase or the next phase. Right. Retirement today is not the same as retirement for my parents. Retirement for my parents was really, we want to play golf or watch TV or travel, and that's it. Today, retirement, a lot of people, when they're retiring, they're doing an avocation or something that they always wanted to do that they couldn't do when they were working full time.
Right.
The third phase after this transition phase is figuring out the distribution order. How am I going to get paid? I got to pay attention to taxes big time. I'm an insurance licensed person too, and I've moved into Medicare. And so your Medicare, your Plan B Medicare, is how much you're paying every month is contingent on how much you're making. So if you can control your tax profile in this distribution during life, then it's a major thing to do. And obviously maximizing the amount of income that you have in life is also something that is on a lot of people's mind. And then the last phase is, as we get older, we have to figure out how we're going to distribute our wealth when we're not here anymore. There's only three places our money goes. It goes to those people that we love. It can go to charities, or it goes to the government. Those are the only three places it goes. So you got to put a lot of time, energy, and effort into that as well.
Thank you. Mm-hmm. I wasn't expecting such a long answer. I already have my brain hurts already, and we've only been here 5 minutes. This is gonna be good.
I like that last comment that you made, because it really is like your money is gonna go somewhere, right? Mm-hmm. And you just choose, right? Who do you maybe who do you like least, or who do you hate the most?
Right. That's funny that you say that, because I actually did a marketing about living trust again yesterday. So that's like a big buzzword right now. So, that's definitely also I think that you assisted people with that, with estate planning and trust and all that stuff too, right? Yeah. So, and before I continue, thank you for your service. Appreciate it.
You're welcome. It was my honor and my pleasure.
So yeah. What made you get into Medicare? Didn't you want to retire? You just want to keep working?
I have a friend who has been kind of dripping on me for the last 10 years. And as things started winding down at Schwab, he and I were talking more and more. And, there's certain juice into being able to illuminate confusing topics for people. And I like working face-to-face with people. I like getting to know what's on their mind, exactly what their situation is, and then being a part of the solution. the number of people entering Medicare, the demographics of this, people are living longer, so there's a lot of people on Medicare, but there's still a lot of people entering into the Medicare age. And so there's a lot of need for this. So that's what I'm doing.
Awesome. Congratulations.
Thanks.
So you're not in the retirement phase where you're just gonna work until you're dead.
Well, one of the things I wanted to do, I always worked for a big company, getting my kids through college, having healthcare, having the security of a corporate job. That was one of those things that was on my mind. But in the back of my mind, ever since high school, I always wanted to kind of do something on my own. And this is one way of doing that. And it's been right now, I'm coming to you from a rigged up camera to my computer. I wasn't sure if it's going to work before we got in here. So that's one small detail of doing things on your own. All that stuff was taken care of for me when I worked for a big company.
Yeah.
Well, we're happy that it worked. We're proud of you. Keep it up.
I have an immense amount of respect for you guys, the entrepreneurs, people who are putting things together for themselves. I've always had an immense amount of respect for that. So hopefully I can join the ranks.
Yes.
Oh, definitely.
I believe in you. Okay. Sorry, we got a little off topic there, but sidetracking. I'm good at that. But so as we were discussing, certified financial planning can be an intimidating topic, or someone who doesn't, we talk a lot about financial illiteracy because we're not taught it in school. And if you don't know, you don't know what you don't know. And unless you ask questions, and a lot of people don't like to ask questions because they think they're going to sound stupid. But that's why we're here, to maybe ask the questions that people don't, that they think are dumb questions. So we kind of wanted to run some things by you, as I'm going to admit, I don't work with a CFP. I never have. I don't know if these two have. But, for somebody like me who is, learning more about investments and financial planning and all of these things, I definitely have some questions for you. I think that they got some questions for you. So we're just kind of gonna see, like, maybe like generally what type of people you work with, and, like stuff like that, what we need to know, your designations, how we get started. If you have any tips for us maybe at the end, or, anything that you want to add, just so that we can get a general idea as to how to maybe, when we get to that point, incorporate having a CFP in our financial, pocket, or, our educational pocket, financial planning pocket. So with that being said, we will have ladies first over here, Miss Rubit Ramos. I know she's probably in the same boat as me on the I'm scared to talk to a CFP.
You're talking to one now? Are you scared?
No. It's virtually, so it's not that scary.
Right.
Okay, well, Rob, thank you so much for being here with us. We truly appreciate it. I'm really excited to know a little bit more about you and everything that you have for us. I do want to ask, what is your investing philosophy?
Well, my personal investment philosophy is never take more risk than I need to achieve a stated goal. So, I've dealt with a lot of people, some very, very, very wealthy people. And some of those people got their wealth because they did not have diversification. They owned real estate, or they owned certain, like Microsoft or Apple at the inception. Okay. And they had most of their wealth in that, and they had the right stocks, and they did very well. But by the time they got to my desk, it wasn't about accumulation anymore. It was about, how do I keep it, and how do I make sure that I don't lose it? So when you're dealing with a certified financial planner, the very, very first step that a certified financial planner, what they're incumbent to do is to understand your personal and financial situation. So if you're in the accumulation phase, the investment philosophy is going to be different than if somebody is in their distribution phase. So explore anything that is going to benefit you. Now, let me give you for instance, there's the emotional side of investing, and then there's the financial side of investing. I can go through with a spreadsheet and say, this is what is the right thing for you. But if I'm talking about the risk and I say, by the way, this has a 50%, you could lose 50% of your money at any period of time, and I see the color coming out of your face, I know that that's probably not the right investment for you. Okay.
Yeah.
I cannot express to you enough the importance of the emotional side. We call that emotional investing or behavioral investing, because that's where the rubber meets the road. Look, I lived through the best time ever. If I'm going on too long, stop me, okay? But I lived through the best time ever in the stock market. 1995 to 2000, the average stock market was up 26% per year for 4 years. And then we dropped down from 2000 to 2010. It was called the lost decade, because if you had bought investments at the beginning of 2000, by the end of 2010, you were still negative. Okay? If it was just the S&P 500.
Wow.
Okay.
Not if you had a diversified portfolio, and we can get into that later. But watching people who steadfastly said, yes, I'm an aggressive investor, or yes, I can handle the risk. And this gray hair didn't get here by accident, okay? I listened to hundreds of people wondering if they were ever going to get their money back.
Yeah.
Okay. This was very serious times. And so what's the investment philosophy? It has to do with you, and that's what a CFP does. It's interesting when you said, never occurred to me, Dani, that people would be nervous coming to see me. I was always nervous that I was going to be able to provide them with the best ideas.
Right.
That's what I was always concerned about. So it really is a relationship. If you're dealing with a good certified financial planner, it's a relationship where they're trying to understand exactly what your personal financial situation is. And then the next step is based on their knowledge, saying, hey, this is the typical thing, right? A client comes in, they're married or they have kids, and they're like, hey, I've got this money over here and I want to do this. Like maybe it's a 401k rollover. Okay, so you should open up an IRA if you want to roll it over and make sure you put in beneficiaries. Well, why are you saying that is the first thing to do? Because I'm telling you, in my experience, the investments are dwarfed in comparison if somebody dies and doesn't have their beneficiary selected. The amount of trouble in court and probate, and not to mention the family.
Right.
Why didn't mom think about putting me, why didn't dad put me in the will? These are all things that are real life, and they create an immense amount of pain and misery that I think are beyond what happens if somebody selects one mutual fund versus the other.
Yeah.
So that's the second thing, identifies the select goes. So the certified financial planner says, okay, thank you for letting me understand this. Did you consider this, 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 and this? Okay. Beneficiary selection, taxes, the titling, these types of things. And then, and only then, after they analyze what the client is currently doing, the fourth step in the financial planning process is coming up, developing and analyzing the current situation the client's in, what their goals are after they talked with the planner, saying, oh yeah, we need to incorporate and we don't have insurance on the house, or we don't have disability insurance, or we don't have health insurance, these things. And so it's only then that the financial planner can develop the plan. And then the fifth step in the financial planning process is coming to the client with those recommendations.
Right. Sounds a lot like writing a life insurance policy.
Yeah, hopefully.
Same.
Yeah.
For sure. Thank you. Yeah. You said never take more risk than needed. So yeah, it really just depends on how risk averse the client is. And do you like change your philosophy based on their conservatability or not? Maybe? Like, does their philosophy change with each client, or does it pretty much stay the same? But, do you have to adjust accordingly to who you're working with?
Always change it with the client, and try to give the client this is where I think you are. Here's if you want to have better returns, this is the kind of risk you would be accepting. And here's if I've kind of misinterpreted how much risk you can stand, what the return is. But the recommendations are always going to come from, this is the end result.
Okay.
If you can't meet your financial goals because you're not willing to take the risk, then you have to adjust your goals, or you have to adjust the amount of risk you're willing to take.
Mm-hmm.
Awesome. Thank you.
Okay.
Thank you.
Yeah.
Awfully quiet up there today, Gordon.
Sorry, I'm over here like multitasking. I'm putting it on different social media sites and sharing the link and all of this stuff. I'm
No worries.
a lot going on.
Yeah. Let's see. Oh, since you're busy, so we went over, what was it? Stocks, bonds, commercial paper options, international stocks and bonds, money markets and CDs, and treasuries, convertible securities. What other services do you offer as a CFP?
So just to be clear, I'm not offering those services right now, but those are experience that I have. So knowing how each one of those act. So let's use stock options as an example. Very few people understand what stock options are, but I'll give you an example. I had a client that had a large amount of money in a company that you would be very familiar with. I'm not going to mention it, but and they were getting bought out by Coca-Cola. So he had a large amount of stock that was going up in value, but his main concern was he kind of knew some of the insides of this company and thought this thing isn't going to last. So I don't want to miss out on the run up, but I want to protect myself. So we were able to implement utilizing experts. I didn't come up with the specific investments because I know how certain strategies within the option markets work. We were able to implement a strategy that gave him limited upside, but also prevented the downside. Okay. And the biggest problem we had two problems, to be frank. The first was trying to allow him to understand how it worked, because it is a different world. The second one is, even though he made multi-millions dollars with no downside, the stock continued to go up. And so even though he didn't sell all of his stock, sometimes he would come into my office and say, man, I would have had $20 million at this point. The fact that he had 6, I was like, remember, we can't tell the future. All we did was implement a strategy. So that might, I don't know what that sounds like to you or your listeners, but I can tell you what we did is implement a strategy based on what the client's goals and needs are. I know his family, I know everything, all the challenges that he's faced with, and I know for a fact that he doesn't have to worry about money for the rest of his life. So I still think he made the right decision because I've never met anyone that can tell the future of what a stock price is. So.
Right. Awesome. Thank you.
Okay.
I don't. How did you protect him from downside risk?
Well, you can enter into a strategy that purchases puts. Option strategies are puts and calls. Those are the basic tools. A put means that he could sell the stock to somebody, that somebody would have to buy the stock from him at a certain price. So if the price of the stock goes down, let's say the stock is at 30 and the stock goes down to 20, having a put would force somebody to buy that stock from him at 30.
Okay.
So he's protected.
Right.
The upside and the way, so you can pay for this by selling calls, which is giving someone the right to buy it from you at a higher price. Okay. So that premium that he got for selling the calls allowed him the money to buy the puts. So he essentially had zero cost out of his own pocket. And, if the stock went up $10 or $5, I can't remember exactly what it was, he had to sell at that price. So he still made a profit on the stock from its current price, but not when it went even further up. So this was a multi-year strategy and the stock kept going up for him. So
awesome. Thank you.
Yeah.
Thank you for that. Puts and calls. Never heard of it, but I wrote it down.
Yeah.
I'm taking notes over here.
I think there's 44 different option strategies. Some of them are extremely risky, and some clients would utilize those, but I would never get in. Even though I am a registered option principal, I never recommended strategies that didn't have either a hedge or were very basic strategies. But insurance companies and other players out there, hedge funds and so forth, utilize these strategies to protect large positions or to leverage positions. Because the benefit of an option is you don't have to put as much money as in a stock. It's a tenth of the price, if not less.
Oh. Gotcha. Thank you.
Okay.
Are you still busy up there, G?
No, I'm good. Yeah. No, Rob, I got a question for you. So can you describe what your typical client looks like and what kind of requirements you have? Or as you said, you're not doing that so much anymore, but what that looks like and what kind of requirements need to be met before somebody is taken on that journey?
Well, let's just talk about financial planning to begin, as a general rule, and then I'll talk a little bit about myself. There are financial planners, and I've done it too, where I just do pro bono work, just to help people kind of get the lay of the land and give them ideas of what their next step should be, and as long as I'm following the financial planning process, there doesn't have to be a charge for that. But where I worked, I had to engage people at a certain level.
Yeah.
Unfortunately, I didn't qualify people, before they came in. A lot of times I was dealing with somebody's parents or somebody's kids that didn't have near as much as my original client. So my average client was probably $2.5–3 million. I had some very, very large dollar clients, deca millions. And then I had some clients, as they retired and spent their money, they were, $500,000–600,000. my role as a certified financial planner there was to understand what tools the firm I worked for could bring to bear. So, and the benefit of where I worked for is they really had, starting at $5,000, they had a way for people that don't know anything about investing to get diversified and to get started in the market without putting, without listening to Uncle George, about what is the best stock to buy, So they really did a good job of that. And then they had extremely sophisticated tools on, for the, multi-millionaires. So I was assigned with, hey, find the right place for these clients. And that's the way that worked. By the way, I did use annuities. And as somebody who has been life insurance certified since 2012, I did a lot of referrals to long-term care, not to mention umbrella policies and making sure people are covered on that side. How would you like to retire with a couple of $1,000,000 and then have somebody break their spinal cord on your property and they told you they're insured and they weren't, and you don't have an umbrella policy? That would just wreck a retirement. So these ancillary ideas are meant to protect the wealth that somebody's accumulated.
Yeah. I guess a follow-up question. If somebody doesn't have a significant amount of money to get started, I believe Charles Schwab has like an app that you can just log on, create an account, and start for a smaller amount of money, right?
$1, yeah.
Yeah, exactly. Like, what is the difference, I guess? Maybe it's just the more personalized attention and time and things like that with somebody, say, that has, just a few bucks to get started and they want to learn, and somebody that has, say, 50,000, 100,000, I don't know.
Yeah, so I think if you look at Schwab in particular, and this isn't an advertisement and I'm not compensated by them at all, but they have a service for as little as $5,000 that you can get diversified. It's called the Intelligent Portfolios. And then for as little as 25, you can actually, and there's a fee for the one with 25,000, you can actually have a video relationship with a certified financial planning team, and then it goes up, up from there. So sometimes people, typically I was dealing with clients that knew a lot about stocks and didn't know anything about bonds, or vice versa. So they might say, hey, I don't want your help on this part of my portfolio, but what do you have on these other areas? Dani, you brought up trusts. That's massive. A lot of people in California, if they own a home, they should have a trust, because you can have a joint tenants with rights of survivorship, but you can't have a beneficiary designation on a piece of real property. You can have tenants in common relationship, but that has probate implications as well. So, a trust can cost between $1,000 and $2,000, and it's a hell of an investment. I'm not a trust attorney, but I've seen what happens if people don't plan for that. And I think there's something called a small estate in California. And again, I'm not an attorney, but I think that's at $250,000. If the estate's over 250, you have to go through probate to get it settled. And I'm happy to talk to you about what probate means. Do you want me to give you a little bit of color of that, by the way?
Sure.
Yeah, I think that'd be
good. So let's assume that you go through probate. So there's a tax on probate. There's fees associated with probate court. So if you have to go through probate, it's a matter of public record. So if you're going through probate, anybody who wants to know, and there are people that want to know who owns that property, who's going to inherit it, the whole 9 yards. It's a matter of public record. And the process, we only have one probate court here in San Diego. We used to have two. We used to have the one up in Vista as well, but that closed down in the 2008-2010 debacle. So it can take between 6 months and 2 years, okay,
Right.
for the probate. And not to mention that attorneys charge for that.
Yeah.
Okay. On the other hand, if you have a trust, or if you have a designated beneficiary on your account, or a joint tenancy with rights of survivorship, those bypass the probate court. So if I have my daughter as my joint tenant and I die, she goes to the financial company and they just put it in her name. The courts don't have to get involved. So anybody that hasn't taken care to understand how their accounts are registered, please do so. There's no fee to do it. And the banking institutions you talk with should be able to give you just straight line. They're not going to tell you what to do, but they can tell you the implications of either one. It's an easy way to protect yourself that doesn't cost you a dime.
Right. Yeah, it's better than, that's definitely, we've been trying to educate people as to how important it is, you know, like you were saying. No, that probate is so nasty. We've heard so many stories, like horror stories of probate. So we totally understand where you're coming from with that. So yeah.
The fact that
Definitely.
these alternatives are not a matter of public record is also a big deal, you know.
Right.
Yeah.
Mhm.
Let's see. This is good. We're gonna have you back again in 2 weeks, right?
I think 2 weeks.
Yeah.
I know I'm on a road trip, so whenever that date is, yeah.
Okay. Let's see. Do all CFPs have a fiduciary duty, and what is it?
Well, yes, all CFPs do have a fiduciary responsibility, and it's quite extensive. If they have a CFP and they have the marks, which is CFP capital letters with the R next to it, there is a fiduciary responsibility to put the needs of the client ahead of their own, the needs of the client ahead of the company they work for. Okay. That's the basics, but it's about a 800-word expository on what the fiduciary responsibility can mean. There's the duty of care. There's a duty of understanding of what the client situation is, and making sure that if there is a conflict of interest, look, guys, there's always a conflict of interest if you're doing a professional period. Because if a professional is getting compensated, then there is a potential conflict of interest, period. Mm-hmm. Okay, I spent 28 years telling people exactly how I was paid. So I'm a little bit hard on my financial professionals. I would get clients coming in and telling me, I bought this thing and, they didn't, I don't think they got paid, you know. And I'm like, all right, well, okay. But the CFP says if there is a potential conflict of interest, then the client needs to know what that potential conflict of interest, and the CFP professional must understand that the client understands that they know what it is. There has to be very clear understanding of this. This has been a big topic. It's always been a big topic for CFP, but it's really become much more clear in the last, say, 7 or 8 years.
Right.
Yeah.
Thank you. So I gotta find the 800-word explanation. And
CFP.com or CFP.net, I think. Yeah, yeah.
I'm sure you have a copy. Email it to me. Ruby, you have any more questions?
Yeah. Let's see. Okay. So how do you determine investment benchmarks and which ones do you use?
Investment benchmarks are great because they offer long-term data of upside and downside. How much has this, let's call it the banking index. Let's just call it that. And the banking index, there's probably a small cap and a large cap, but let's just say the banking index. So companies that are bankers, you know, they're what's their peak, the best they've ever done in any given year, and what's the worst they've ever done in a given year, and what's the average. And then what's the dispersion between up years and down years? Is it usually up or is it usually down? Once you do that, and you've got that, you can then find something called a correlation. So if one of the basics of investment management is diversification. So if I have a index of 1, which is the S&P 500, I can look for something that has much less of a correlation. Let's call it Australian dollars. That's probably not a real big negative correlation, but let's just pretend. Let's call it stamps. Okay, let's say that's what it is, right? So you are looking for negative correlation to your main investment. If your main investment is going to be in stocks, then you want to have something that's negatively correlated. Bonds or cash is usually the preferred alternative, because usually when stocks are going up, bonds and cash are not, and vice versa. Okay. So dollar versus gold. It's really interesting. That's an excellent question. When we're talking about correlations, we're looking long term. And yes, that would be a negative correlation, gold versus the dollar. But sometimes it's crazy. You'll see those things correlated like crazy. Bitcoin was supposed to be negative correlated to the stock market. But guess what happened in 2002? They both got crushed. Yeah. So you don't always see 100%, negative correlation. It really has to do with really more macroeconomics. And there's been a lot of question in the community, in the financial planning community for a long time. Okay. You've heard about globalization. And so year after year, there was always talk within the community of, are international stocks truly negatively correlated to stocks, to US stocks? Because something like 60 or 70% of US stocks get their a large amount of their income from international sources, and a large amount of international companies get their earnings from American markets. So right. That correlation, when I first got in the market, was very extreme. There was a good negative correlation, but not lately. So just because things were negatively correlated doesn't mean that they're going to continue to be. Does that answer your question?
Okay.
I got a follow-up or maybe a semi-related question.
Okay.
You talk about risk and the inability to predict, right, the stock market, and then you're talking about the correlation and things like that, how sometimes it goes against what history has shown us maybe. What do you think AI is going to do to all of this? Because I know big firms have already come up with software that kind of tries to track and predict and all of that. But do you think artificial intelligence is going to have a big impact on the ability to predict what the market's going to do?
I'm no expert on AI at all. But there was a company called Long-Term Capital Management in the early 90s. Have you ever heard of this story? Smartest people out there. They work for Solomon, and they decided to start a hedge fund. And there's actually a PBS special on this. One of the lines I remember in it is, when these people came to your doorstep and asked for money, you wanted to give them money because that's how smart they were considered. Essentially, they created a hedge fund called Long-Term Capital Management, and they bet based on their computer analysis. They had amazing returns, 44, I can't remember the returns, but over 40% for something like 4 years. But then everything came crashing down in 95 or 96 with the Asian currency crisis. Okay? Long-term capital management was leveraged. So they ended up losing $1 trillion. Now, in 1995 and 96, $1 trillion was still an unimaginable amount of money. It is an unimaginable amount of money if you think about it, but we talk about trillions all the time. But the Federal Reserve Chairman, Alan Greenspan, went to the American commercial banks, and they bailed out long-term capital management to the tune of $1 trillion. So my belief is that when you have technology, that creates greater volatility. And I think that would be my only prediction, that we're probably going to see greater volatility. Do you remember, I remember I was on the way to the dentist, the orthodontist for a meeting with my son. The stock market lost 1,000 points. Okay. When I left that day, it was just like down 200. And on my way back from the orthodontist, it was down 1,000 points. And they were screaming all over CNBC. By the time the day ended, the market was only down 150 points or so. So wow. Significant, because as the market goes down, stop orders get filled. So people were forced to sell their Apple and their Microsoft and all these other companies that they loved at lower and lower prices because they had entered stop orders. And then by the end of the day, the stock was much higher than when they sold it. Okay. Those are, limit orders are basically robo orders. You're saying, hey, look, I own a stock at 100. If it goes to 50, I want to make sure it gets sold because I don't want to lose more than that amount. And so as that stock market, so I think with the AI combined with ETFs, which are one of the biggest players in the stock market, that those two combined could cause a lot of volatility.
Yeah, thank you.
Wow. That's insane.
I hadn't thought about AI yet. Gee, that's a thank you. Now that would play a part.
I don't want the role, the title Rob Woodard AI expert.
We won't label you that.
We'd all be in a bad way if that were true. Yeah.
Right.
Yeah.
I'll have to watch the PBS documentary on that.
Long-term capital management. Yeah. I already put it in my search. I'm going to be looking at it later.
That's funny.
Well, it's funny because the numbers they're talking about, in today's standards, hey, they got $250 million in 10 days or something like that. And these days, okay, 250 million, it's to us, it's a ton of money, but to the capital markets, it's just the dollar has gone up so much. It's inflated so much that 250 million doesn't sound like a lot to a lot of those players.
Yeah. Sounds like a lot to me.
Yeah, it was back then, I'll tell you.
All right. We've got a little bit more time with you. We don't want to take up your whole day.
I can come back around if you want me to and kind of summarize what it's like to work with a financial planner.
If you want, and then if you have, I know that you said you're not taking clients for CF certified financial planning at the moment. But if you'd like to share what services you're offering now and how people can reach out to you. I know we're gonna have you back.
I
And
put
like
that in the chat. Yeah, and I'm basically doing insurance now. Medicare insurance is what I'm focusing on because I'm of that age. I went into business with my daughter, so she's going to be focusing on health, and then we're both doing life together. So, and I still have my Series 7. I don't know if I'm going to do annuities or not. I do like annuities. I think every investment has its place. And if you know the client, if I know what's happening for the client, then I'm going to be able to offer, the solution that's right for them in their circumstance. And that it shouldn't be cookie cutter for every single person. So with Medicare, I represent 5 different companies and 61 plans. Well, each one of those plans is made for specific people. There's something called dual special needs and chronic special needs. So some people have medical needs that are special that allow them to change their plans a lot more often than regular Medicare recipients. And same thing with the dual, that's you can combine or get assistance with your fees through, in California, it's called Medi-Cal, and in other states, it's called Medicare, Medicaid.
Medicaid.
So these are, and that's just to name a few of the different types of plans. But
Right.
And then on the life insurance front, I told my daughter, she's 28. She's got a child. I have a grandfather now. That
Congratulations.
Thank you. If you have a family and you don't have, my dad died and he left us a little bit of life insurance, but we were living overseas, had to come back, didn't really have anywhere to go. I grew up, my mother was, she ended up getting an accountant degree, but she was terrible with money. She loved to spend money, and if you spend more than you're making, it can be difficult, so, having a life insurance policy for a young family is one of the main decisions, kind of a backstop. So you can be accumulating assets, but if something happens and you don't have a life insurance policy, I can just tell you from personal experience, but also from professional experience, the tragedy of not having that in the place that the heirs are put under, it can be a life-changing event. So for young people looking at life insurance, making decisions on whole versus term versus maybe an IUL or something like that. If you're looking for college planning, I have a good friend of mine who's into college planning. And so they use these life insurance policies as a means to get assets out of the estate so that when it comes time to get college funding, it doesn't show up on the FAFSA. Right. So, these are all the considerations that are worth your time. It's definitely worth it. And instead of looking at like, I'm going to be out $200 a month or $500 a month, whatever it is, you look at it as, this is what I'm doing for my family. This is why I'm working and I'm doing this, not just to go buy, I shouldn't say, not just go buy Starbucks every day, but so that I can then benefit, not only myself, but also knowing that I'm doing something for my family and my legacy, even at a young age. Now, that sounds like criticism. I wasn't really thinking about that kind of stuff when I was 28, but luckily my daughter, because I brought her up talking about finances a lot, it is on her mind, and her and her husband have a policy right now. So
we love to hear.
Yeah.
Well, we'll have to get some more information from you on your Medicare journey. And, based on that, they're both in Oceanside. Obviously, I'm from Oceanside. So, maybe some people that they know could connect with you. So I think we'll put together some questions. Maybe, we can have you give us a Medicare training kind of thing. And then, hopefully we can get you some clients, and you can help our friends or family if they need, and vice versa.
Yeah. Thank you.
And let's see. So we know that we can contact you.
Yeah, I put my email and my telephone number.
Right. So your email is robw1964@gmail.com. And then your telephone number, I hope people don't just start calling you and you're gonna be like, are you single? Are you married? He's very educated. I want him to take me on a date. Telephone number is 760-206-6523. Is that correct?
Yes.
Or any questions or concerns, or if they need a referral necessarily potentially to someone who is still working in certified financial planning services, or you said that some of your people offer pro bono or whatever, if they just have questions, they can contact you at either of those. Is that correct?
Correct.
Awesome. Well, do you guys have any other questions for Mr. Rob? Does your brain hurt like mine does? There were a lot of big words thrown around, and I'm like, wait a minute, I'm gonna need a dictionary. Well, yeah.
Sorry.
Go ahead.
No, I was just saying, I again, thank you for joining us. Thank you for sharing this information. A lot of great information. But I think that it would be a good idea next time maybe to share like a little more on like your typical client. I know you talked about your typical client, but I know there's age restrictions and income things and all of that apply directly to the people that you help, and that way we can help narrow down who your typical, I guess typical is the best way to explain a client would be, or ideal client maybe. So.
Yeah. And there were some other questions that we didn't necessarily touch base on, so we can maybe kind of start with finishing this topic of conversation and then kind of segue into, the Medicare business and all of what's included with Medicare and how you apply or what qualifies you and all that stuff. Sorry, the wind's blowing, so my table's attack. But yeah, if you guys don't have anything else, I do want to thank you so much again for your time, for all of the information. It was very educational. Like I said, I'm gonna need a dictionary. I have a lot of studying to do. I know you're not taking clients, but you may have a new one right here. Yeah. I'm gonna steal all of your information. You're hired. No.
But anytime. It's really been my pleasure. I must have done all the talking because it feels like it was just about a 10-minute conversation here. So sorry if I kind of was verbose. I'm usually not that way.
We do not mind at all. We appreciate it. We thank you so much. And we hope to see you guys. We're going to have you back on our next episode on I don't know what the date is, but 2 weeks from today. Until then, everyone, thank you for joining in. We hope that you got as much information as we did. We hope to see you next time. And as always, we wish you well. Take care.
Thank you. Thank you.